In this video, we will explore about position limits in the derivatives market. Whenever you trade futures and options, the exchange places certain restrictions on the maximum number of contracts you can hold at any given time. This restriction is called a position limit. The main purpose of having these limits is to maintain a fair market. They prevent any single trader from manipulating prices or gaining too much control over the market or a specific stock. To keep everything in check, these limits are applied at three different levels. We have the client level position limit, the trading member wise position limit, and finally the market wide position limit. Let us look at each of these in detail. Starting with the first level, let us discuss how client level position limits work for individual securities. When you trade futures and options on a specific stock, your total open position across all those contracts cannot exceed a certain maximum threshold. To find this maximum limit, we calculate two numbers and take whichever is higher. The first number is 1% of the company's free float market capitalization measured in the number of shares. The second number is 5% of the total open interest for all derivative contracts on that exact same stock across the exchange, again measured in shares. Whichever of these two numbers is greater becomes your absolute limit as a client. Still looking at the client level, there is a very important reporting rule for groups acting together, known as acting in concert. If a group of people act together and manage to acquire 15% or more of the total open interest on any particular index, this triggers a mandatory action. They are strictly required to report this large holding directly to the exchange and the clearing corporation. If they fail to report this fact, it is treated as a serious violation. This failure will attract severe penal and disciplinary actions according to the rules and regulations set by the clearing corporation. Moving up to the next level, we have the trading member wise position limits for index derivatives. These limits apply to the brokers or trading members themselves. For index futures, the limit is set at whichever is higher between two figures. Those figures are rupees 7,500 crores or 15% of the total open interest in the entire market for index futures. This limit applies across all open positions on a specific underlying index. The exact same rule and calculation applies to index options as well. The limit is the higher of rupees 7,500 crores or 15% of the total market open interest for those index options. Now, let us look at the trading member limits for individual securities rather than the broader index. For a specific stock, the trading members' combined limit for both futures and options is capped at exactly 20% of the applicable market-wide position limit. The timing for calculating this is quite predictable. The clearing corporation officially calculates and specifies these member limits on the very last trading day of the month, and those limits are then strictly applied and monitored throughout the entire next month. This brings us to the third and broadest level, which is the market-wide position limit. This limit looks at the overall maximum open interest allowed for a specific stock across the entire market. The formula is quite straightforward. The market-wide position limit is set at exactly 20% of the shares held by non-promoters. This simply means 20% of the freely floating shares of that specific company. Just like the trading member limits, this broad market limit is officially calculated by the clearing corporation on the final trading day of the month, and it remains the benchmark for the entire following month. To make sure the market does not suddenly breach this market-wide position limit, the system has built-in alerts and bans based on the total open interest across all exchanges. When the open interest reaches 60% of the limit, the trading systems automatically display a warning alert. If trading continues and the open interest crosses the critical danger zone of 95%, a complete ban on new positions is triggered for the very next trading day. During this ban, no one can open fresh contracts. Normal trading will only resume when the overall open interest finally drops back down to 80% or below. While these standard market-wide position limits apply to general market participants, there are additional layers of rules for specific types of large investors. Apart from the standard limits we just discussed, specialized position limit rules are applied to foreign portfolio investors, mutual funds, and non-resident individuals. These specific regulations and restrictions are carefully detailed in a SEBI circular dated November 5th, 2019, as well as the SEBI Foreign Portfolio Investor Regulations of 2019. Let us dive back into the index side of things and look at limits based on a person's permanent account number. For index options, there are specific limits at this level. Your net open interest for equity futures at the end of the day cannot exceed rupees 1,500 crores. Additionally, your absolute gross open interest for equity futures is capped at rupees 10,000 crores. These hard financial ceilings ensure that no single entity can build up a dangerously large position under a single tax identity. Similar strict limits exist for index futures, and these are measured on a gross notional basis across different investor categories. For mutual funds, proprietary trading members, clients, and category 1 foreign portfolio investors, the limit is the higher of 15% of the index futures open interest or rupees 500 crores. For category 2, foreign portfolio investors, excluding individuals and family offices, the limit drops to the higher of 10% or rupees 500 crores. Finally, for category 2 individuals and family offices, it is even tighter, set at the higher of 5% or rupees 500 crores. Understanding how these limits change dynamically is also crucial. Generally, position limits are based on the total open interest of the market at the end of the previous day's trade. Because of this, if the overall open interest suddenly drops during the day, market participants might accidentally breach their limits without realizing it. The exchange currently provides a system to monitor this intraday fluctuation. However, there is a big change coming. By December 5th, 2025, the exchange will stop monitoring this specific equity futures open interest, and broking firms will be entirely responsible for using their own systems to compute and monitor these limits. To manage risks while the market is actively trading, there are strict intraday monitoring limits set in place. During the trading day, your net position limit for equity futures is strictly capped at rupees 5,000 crores. Additionally, your overall gross position limit for equity futures during the day cannot exceed rupees 10,000 crores. These massive figures act as a real-time ceiling to prevent excessive risk taking before the market closes and the final end of day calculations are performed. You might wonder how the exchanges actually monitor these intraday limits. They do not just check at the end of the day. Instead, they use a random snapshot mechanism. The stock exchanges take a minimum of 4 random snapshots of the market positions throughout the entire trading day. This specifically applies to equity index derivative contracts. One of these snapshots is considered highly critical and always takes place between 14:45 hours and 15:30 hours, which is around the market closing time when trading activity usually hits its peak. So, what happens if someone breaks these rules? Let us look at the violations and penalties. If a client exceeds their limit, the exchange immediately slaps a penalty on the clearing member. The clearing member then recovers this money directly from the trading member or the client. As an immediate action, the client is banned from taking any fresh positions and is forced to reduce their existing ones. For trading members, the rules are equally strict. They are monitored constantly throughout the day, and if they violate a limit, they are completely blocked from increasing their open positions in that specific security or index. Finally, let us discuss What happens when the massive market-wide position limit is violated, leading to a ban period? The exchange checks for this specific violation at the end of every single trading day. If a stock is officially placed under a ban, a very strict rule kicks in. If any member or client tries to increase their existing positions or boldly creates brand new positions while this ban is in force, a heavy penalty is charged. This penalty is swiftly recovered from the affiliated clearing member on a T+1 day basis, right alongside their regular payment obligations.